Welcome to Go Bank Yourself, where we break down how to grow and control capital like a banker. I'm your host, Dovi Herman, joined by my co-host, Pinny Levy. Let's begin. Welcome back, everybody. Thanks for tuning in. Go Bank Yourself, episode 4. How you doing, Penny?
Doing great, thank God. How are you, Dovi?
Good, thank you. I want to cover an important topic today. We touched on it before in previous episodes, the difference between APR, annual percentage rate, versus volume of interest. Because when somebody goes to take a loan and supposedly they're going to get an 8% APR, they're going to pay 8%, we think we're paying 8%. But when you look at all the total payments over time going towards that loan, you find a different number. And that would be called the volume of interest. So let's say $500 a month over 60 months. You come out with a total amount paid over those 5 years. What was that total number? Okay, well, how much of that was interest?
In our brains, the magic pixie dust over Americans' brains are think monthly, can I afford it? And does the interest rate make sense to me? Meaning when interest rates for a 30-year mortgage were dropping lower and lower and lower, and we got into the house we currently live 10 years ago, we bought it 3.875, thinking, that's pretty good, I'm not going to fight it, I'm not going to hassle. And then they kept going lower. Do I want to refinance? Well, the answer, by the way, was no, because you're going to reset your clock on how much of each payment is now going to be towards the interest versus the principal. But then you're resetting your fees and your closing costs. Not always a no. It's not always a yes, you should refinance, even when the rates went a point lower. But what nobody thinks about is what's the volume of interest I'm paying. They're thinking, can I make the payment, and does it seem like a good rate?
It's a separate topic for another episode, but there are reasons to take a cash out refi, start over that mortgage payment, depending on what you're doing with the cash. If you're using it with IBC, we're not going to go into that right now. It's not the topic of the episode. Sure. I've seen IBC practitioners who always take the cash out refi and put that cash back into their policy.
True, but what I was harping on was chasing a low interest rate. If someone says, you're going to have a lower interest rate, do you go through all the blood and guts and gore to renegotiate a mortgage and to refinance and pay that bank or broker or both their upfront fees just to have a lower rate? Sometimes it makes sense, not always. So in order to sort of prove this or dig into the numbers, we'll look into a couple very typical things, because every American has financed a car and most people have financed a home. So I'm going to set up a screen and jump in and look at some numbers together.
The classic becoming your own banker example, an IBC example, is with buying a car through a bank versus through a policy loan, because almost everyone has gone through the process of buying a car. We all need cars. Some people lease. Again, there's still a finance charge on leasing. So for all you people out there who only lease, and that's neither here nor there, I see the argument for leasing. You can still run IBC in your life through leasing your vehicles.
Yep. So let's take a look. The downfall of the way we're taught money is, can I afford it? So you come on that $30,000 Honda Accord. I don't know what trim level that buys these days. And you walk into the dealer, and a typical car note's 5 years. And a typical interest rate, now we're talking second quarter 2026, 8%. I mean, haggle with me. Is it a little higher, a little lower? Maybe with like superb credit, a little lower. Maybe if there's some big dealer incentives on that car, it might bleed over to the interest rate.
These days, I believe most car loans are actually more like 6 or 7 years, because people are struggling to maintain a 5-year note, so they're stretching it out.
Right. Typically also pre-owned, these might get even higher, 10 to 12% range. And yeah, that kicks people's monthly payments too high, which is exactly you run a $30,000 loan, 5 years, 8%. So this happens to be calculator.net. They have every type of financial calculator out there. Not sponsors yet, but tells you clearly that the payment every month is $608. Multiply by 5 years, 60 payments. It's $36,497. Call it $36,500. So subtract what we borrowed, $30,000. Clear as day. Right there's the first eye opener for most Americans that if they're only thinking, can I afford the payment? They're not even drilling down on the numbers to find out how much interest they paid. Certainly not in a lease, because there is no, I mean, a lease is all financed. You don't own anything. But again, like Dovi says, the convenience of that might overcome the other factors, more subjective, but $6,500. So what's the volume of interest? To find that, you would multiply the you divide the 6,500 by the total amount of money you spent on this out of pocket, 36,500. So the whole donut is 36,500. It comes out that 18% of those dollars were interest dollars, and that's the volume of interest. Right away, the math reveals that in our minds, it's a fair rate, the inflation, etc. I need to pay 8% for my car because that's what I'm offered. We have to realize that's 18% by volume of all the money, the blood, sweat, and tears that we went through to earn the money, given over to somebody else's banking system. $6,500.
And this same calculation, of course, applies to every single loan.
Right.
So every time you take out a loan and you see what that APR is, you now know that you're actually paying a whole lot more in interest than you realize.
Right. So I like to use with clients my own personal mortgage. So it's not a 5-year mortgage; it's a 30-year mortgage for $300,000, and it's not 8%, which is kind of a fair credit mortgage rate nowadays. But it was back in the halcyon days of 3.875, and those payments, honey, can we afford $1,400 a month? Sure we can. Well, let's go and pay it for 30 years, 360 payments. That's $507,000. Ergo, $207,000 in interest. Now, before you say that bankers are evil, imagine lending $300,000 and giving someone 30 years to pay back. That's why it's so expensive, but that's $207,000 of interest. Would you rather fork that over to your mortgage bank or have that to invest over and over in the things that you want to invest in? And oh, by the way, the volume of interest in this example is 41%. And I'm not saying that, again, it's not a no-brainer just to refinance at a lower rate. It went down. I don't know if I could have gotten the 2.9s while they were still available, but that lower rate cuts the interest down for sure, but there's other upfront costs and subjective analysis to do before you simply refinance on a mortgage. These days, it's unheard of because the rates are going up. But so that's the general principle of understanding what's that APR. Well, that APR is going to go right here, that annual percentage rate. So for any loan you're presented or any loan you currently have, I mean, go find your paperwork from your car loan and see, because they won't necessarily tell you, but they'll say, here's your payments. If you want to go deeper, the information's there to look. But if you know how much you borrowed and what your payments are, you can reverse engineer what the interest rate is. And for most people, go ahead.
So let's compare an 8% APR on a car loan through a bank versus what it's like to self-finance a car through your own banking system or
through infinite banking,
a dividend-paying whole life policy, or a series of policies.
Sure. So, and it's also, this comes out of the chapter in Becoming Your Own Banker on the grocery store example, where Nelson Nash talks about, he tried to make an example that most people could relate to. I found an experience, some people find the takeaway, which he coined the phrase, don't steal the peas. You're a grocery store owner and you have access to all this stock. Why don't you just take your food off the shelf and go out the back door, bring it home and cook it up? Well, if you steal the peas, if you don't pay retail for those things that you acquired wholesale, or at least at the expense of your business, then you're harming your system, the profitability of that grocery over the years. So here's the way we conceptualize that with our clients at Real Change Financial for using infinite banking for a car loan. So here was that example of $30,000 for the car at 5 years, 8%, and that's $608 a month. Let's say that with whatever insurer, with whatever capital you've built up, you can take a loan, even say 6%, which is a nominal rate. Probably there are higher, there are lower with all the different insurers that we work with. But I would say that looking for the lowest loan fee or loan interest rate is not the primary reason to buy or not to buy from a certain company, from any given company. So we calculate, and comes out that that same 5-year loan through your Infinite Bank is going to come out to $34,800 or $4,799 in interest. So
Let me interrupt you for a second. Is that calculation true though? Because one of the positives to using a policy loan is that it's a very unique type of credit instrument where not only you have complete control over that repayment schedule, and assuming you are being an honest banker and repaying your policy loan every single month like you set up for yourself, every payment you put towards the repayment, it goes directly towards principal. So over the course of the year, over the course of time, less of those payments is actually going towards calculated interest.
it's true. So I'm simplifying, and if we do an episode to look at a policy loan month by month, we could do that. But everyone needs to have a Cuban coffee before that, or some high caffeine dose, because that one could be a snoozer. But I mean, it's eye opening for the numbers, people.
None of this is snooze material, Penny. We're teaching people how to take back more control over their hard-earned money. I think that's the most exciting conversation in the world.
The nicest thing about the 21st century is if you go to a class or you're taking something as education like this, if you're tired, you just swipe. So, or if you're tired with us. But so let's see here.
So I do think that was an important clarification, though. So this is still showing more just its theory on payments.
So in
when
actuality,
you actually look at the numbers of how a policy loan works, it works out a little bit more in the policy owner's favor.
Right. Or to summarize, your total interest, because of the way that the policy loan accrues interest, part from the payments you're making. In practice, the total interest will it'll arithmetically be lower than what I'm showing here as a regular bank loan. $4,800. What was it before? $6,500?
Yeah.
So what Nelson Nash implores everyone to do is to consider what you saved on interest, here about $1,700, and to pay that anyway. What do you mean pay that anyway? It means just because you have access to a better loan with a lower interest rate that produces or that's going to charge you less interest over the course of the loan, well, pay the $608 anyway and pay it for 5 full years. Now, as one part of your brain's thinking, that doesn't make sense because I don't owe it, I like to call it a financial thought experiment. If you didn't have infinite banking in your life, you didn't have access to the capital, and you were at the mercy of the bank or the dealership, what would have stopped you from paying $608 a month? You would have made your life accommodate that. You would have given up the leather seats or give up the lattes every day in order to have the car you wanted and make the payments. So why not have the discipline of paying that here? And you know what? In practice, let me be not a Debbie Downer on American Outlook. I speak to lots of clients who are paying more than the required minimums, whether they're credit card debts or their mortgages or even car loans. So why not have in mind, bookmark in your brain, I'm the guy that pays $608 a month for my 5-year loan for $30,000 on this car. What happens to the difference, that what you overpaid, so to speak? That $1,700, well, that's going to go right into your policy as extra premium. If your policy is a $500 a month policy, so you're capitalizing, you're paying in $6,000 a year in premiums, right? And those are going to get better and better every year, meaning more and more of that $6,000 will be available to you every year until there comes a time when every $500 you pay, your policy is earning $550, $570, $600 every time you pay in. But the year that you finish this loan, that $1,700 is extra. So instead of $6,000, have it in your head, instead of $6,000 going in that year, you paid $7,700. The difference being the $1,700 that you were strict with yourself to pay. It's really not owed to the loans. Where are we putting the money? We're putting it into called the paid up additions rider, the extra capacity that your agent should build into any policy that can accept more money than what's scheduled.
Not to mention adding extra premium will increase the cash value that's in your policy and will increase the dividend that you'll earn every year.
Right, that year and every single year after that. And I just want to point out, even if someone doesn't want to go through that, again, financial thought experiment of paying more, so to speak, or paying the bank's rate or the dealership's rate, even though I have a better deal in most cases, not always the case. Sometimes the life insurance policy loan might have a higher interest rate. But I'm here to say that the math is not the only thing. Here's a subjective case. What if a month happens when there's low income or emergency spending and you don't have enough to pay for your car? I know. You call up the dealership and say, I'm having a bad month. Can you do me a solid? So there's no solids in life when you're talking with the bank. Here, I will say, banksters, you signed, you owe. There's conditions. There are effects if you don't pay.
Right.
There's
one
the nasty
hand,
gram. Go ahead.
On one hand, had you self-financed the loan through your policy, of course, you're in charge of that repayment schedule. You can skip a couple of months if you have a cash crunch in that time period. And on the other hand, if you still went with the bank loan because you saw that there was a much better rate there and it made more sense for you, if you have a policy built up, then in those months where you're having trouble paying your car loan, you can borrow from the policy. A great, savings vehicle and leverage it.
Right. Or ultimately skip a couple payments, skip a couple months, skip a couple years. There's no creditor knocking at your door. Send again with first month you miss, it's a fine. Next month you miss, it's a nasty gram. Next month you miss, it's a repo. That doesn't exist in the infinite banking world because you're the owner of that loan. You own your own debt. Another subjective feature is this loan is not going to be on your credit score. You take a car loan out, you're going to have a secured loan because the car is the security on the loan. Secured loan, $30,000 to ABC creditor, Honda Finance. And then that's tracked. Are you paying it back? Honda will tell your credit agencies if you don't make a payment. So missing payments has a negative credit outcome as well. In the infinite banking world, these are completely below the radar. There's no reporting from the life insurance company to the credit agencies if you've missed a payment because they're not scheduled payments. And if you can't wrap your head around that, what does it mean you can skip payments? Because they don't care if you skip payments until you're 100 years old. What happens at that bitter end when you're 100 years old? Your death benefit's worth, $5-6 million, and your $30,000 car loan is ballooned into a $300,000 car loan because you ignored it. Again, against the strategy of infinite banking.
This is not IBC.
We don't recommend this, but if someone just forgot about their loan for 50 years and now it ballooned into $500,000, $1 million, well, their death benefit, which will mathematically be larger than the amount of that loan, if the policy is designed the right way, then the death benefit pays off any outstanding loans and the remainder transfers as a benefit to the beneficiary. So in that example, your $2 million death benefit will be docked by $300,000 because your car blew up into, 300, make my math easier, $500,000. My car now costs $500,000 because I never serviced the loan. Well, my $2 million policy pays it off and my beneficiary gets $1.5 million. That's how that works at when we're old and gray, I'd may have Esrim when you're 120 years old. So
right.
That is,
and again, we would never recommend somebody runs their banking system like this. This would not be becoming your own banker.
Right. Although,
but it is still a positive feature of
square brackets, in retirement or when one is living on passive income, then that's call that the distribution phase where, yes, we're taking out loans without ever having the intention of paying them back because we are purposely living off of the future death benefit.
Sure.
But that's really something for
that's a whole other topic. Even then, ideally, you're still paying back the interest so that you don't eat up your death benefit for the future. That's my plan, at least. Very
good. So hope that was informative. A little VH1 behind the music on VH1 behind the loan. You think you've got a low APR and life is good, but have you considered all of the numbers behind that? Hopefully by understanding the volume of interest versus the rate of accrual of interest, we can make better decisions with our money. And obviously, Dovey and me, the intention is that to show that really the best pool of capital you can develop is within infinite banking as described and prescribed by Nelson Nash.
Have we shown the book on the podcast yet?
I believe.
My friends, if you have not read Becoming Your Own Banker, it is a must-read. Implementing this strategy into your life, it will change your life. It'll change your life immediately in the way you think about money, and it'll change your life long-term once you do build up a little bit of capital in these policies. Or if you have capital saved already and you're looking for somewhere to store it where you'll have that safety, you'll get long-term growth, you'll have liquidity, you'll have ultimate control, more control than anywhere else you can put it. This is where you want to look. Thank you for listening to Go Bank Yourself. To learn how to apply these strategies in your own life, email Dovi Herman at realchangefinancial.com. We'll see you in the next episode.